Okay, so this will be a very short video on the idea of accounting versus economic profit, which are very important concepts in microeconomics. When we think of accounting profit, we are simply looking at paper profits, as they say. So to calculate this, you take all of the revenues that you get within a given time period, you subtract out all of your expenses, and if that number is positive, you have a profit. If it's negative, you have a loss. Okay, so that's accounting profit. Economic profit is a next level analysis because what it does is it considers your opportunity cost in this. So, for example, you could have a business that generates, uh, say, $80,000 a year of profit for the owner. Um, is that good? Is that bad? Well, it depends on what the opportunity cost is. What is the next best thing that they would have gotten out of that investment in the enterprise? Okay. And so, a very simple example I would use here, let's say that we had Joe that used to make $60,000 a year as an accountant. So he's an accountant in a small town making 60 grand a year, and he decides to open a pizza place. So after a year, he's made 500,000 in revenues. His expenses are 450,000, and that will result in an accounting profit of 50,000, simply the 500 minus the 450. He has, however, incurred an economic loss of 10,000 because his next best alternative is to have been making 60,000 as an accountant. Now, keep in mind these are important concepts, and in the actual business community, numbers are not going to be as cut and dried because you don't have perfect clarity in business. You can say, well, what is my next best thing? You can run cost benefit analysis, that type of situation. But really, the point is that in order to really think and have efficient operations, you need to consider what your alternatives would have been. And so when we think about economic profit, an economic profit is when you are making more than what you could have doing your next best alternative. Okay. And so when firms in an industry are earning an economic profit, that is sending a signal out to other firms that this is an industry worth getting into. There's also a term called normal profit. And a normal profit simply means that they are matching their next best alternative. A firm that's earning a normal profit is not going to cause anyone to enter or leave the market because there are alternatives elsewhere where they can have equivalent outcomes. But the point here really is that when you're looking at whether or not to enter a market, you're going to look at, is it economically profitable? And this is a big thing that we will talk about throughout the course. Are there barriers to entry present? So let's think about something pretty simple. Let's say that somebody started making, I don't know, crochet hats. That seems pretty simple, and that they're able to make crochet hats, and maybe they have a silly saying on them. And they are selling them at the farmer's market, and for whatever reason, people are buying them up. They just think, oh, that's the best. I want a crochet hat with a silly saying on it. Well, there's not a big barrier to entry to keep other people out. And so you see the farmer's market, somebody there with a big wad of money because they've made substantial income doing this. Other people are going to replicate enter the market. And as you may recall when talking about the supply and demand dynamics, that would move the supply curve to the right, putting downward pressure on the price. And eventually the market becomes saturated and thus no more economic profit. It's a really important concept that we will discuss throughout the course, is this idea of barriers to entry into the market.